Welcome to today's deep dive. We're unpacking a really fascinating stack of notes today.
Yeah, it's a raw developer log from May 25th, right? Where they tested a few systems.
Exactly. A parallel test of 3 different AI trading bots. And, if you're building automated workflows or even just investing your own money, you might assume the ultimate goal is to build a machine that just never loses.
Right. But the numbers in this log tell a totally different story. The bots actually took a net loss for the day.
Wait, really? A net loss?
Yeah, a negative 228 Japanese yen in realized loss. And, well, that actually drops to a negative 272 yen when you factor in the open trades.
Okay, but here's the twist that I just love. The developer recorded this as an incredibly successful test.
Which sounds completely counterintuitive.
It does. But celebrating a loss like this, it forces us to ask why failing safely is actually the true benchmark for automation. We aren't just looking at what these bots bought or sold.
No, we're looking at their wildly different design philosophies, especially around how they manage risk.
So let's start with the winner of the day. What happened there?
Well, the standout performer was a bot called LLMBridgeTrader. It trades the euro against the US dollar.
And it actually made money, right?
It did, yeah. It secured a 254 yen profit, entered at 1.16366, and exited at 1.16446. But the profit isn't really the headline here.
Right, it's the mechanism, it's how it trades.
Exactly. Traditional bots usually just trigger an entry and, just hope it hits a target. But this one prompts the AI to continuously evaluate the trade. It actively chooses to open, hold, close, or reverse.
It's acting like an actual co-pilot. Instead of just like a basic cruise control that plows ahead until it hits a wall, it's constantly scanning the road.
Yeah, and when the trade moves in its favor, the AI actively chose to move the stop loss up.
So it's essentially hitting the brakes to lock in that profit.
Precisely. That continuous active management is what protected the games. But compare that to the second bot in the log, BoundSniper.
The one trading the US dollar to yen.
Yeah. It operates entirely differently. It's basically a blind executor. It receives a signal from charting software like TradingView and just buys or sells blindly. No AI management during the trade at all.
But on paper, it closed with a 25 yen profit.
It did, but...
Wait, let me stop you there because the log shows a major catch. That 25 yen is a realized profit, meaning trades that actually finished. But it was hiding a negative 44 yen floating loss on an open position.
Right.
It's basically bragging about winning a hand of poker while you're slowly bleeding out your chips on the table.
That is the perfect way to put it. It's the illusion of surface-level metrics. Realized profit is totally meaningless if your open equity, the actual current value of your account, is sinking in the background. BoundSniper just couldn't manage the open trade.
Which brings me to the part of this log that completely threw me. The third bot, GateGrid AI.
Oh, GateGrid, yeah.
If GateGrid is so smart, it uses Cat Boost for quantitative gating, so heavy machine learning crunching the hard math, and then it layers on a local Llama language model for qualitative filtering.
Acting like an AI gut check.
Right. So with all that brain power, how does it end up being the absolute biggest loser of the test?
Well, it essentially fell victim to the illusion of intelligence. GateGrid shorted the British pound against the US dollar and took a massive 507 yen hit.
Oh, wow.
Yeah, the market moved nearly 32 pips straight against it. And the breakdown happened exactly because it was over-engineered.
So it just overthought it.
Pretty much.
Yeah.
The Cat Boost algorithm fired off a math signal to enter, but instead of having a simple kill switch when the market turned, the Llama language model likely tried to rationalize holding the position.
So it looked at what the log calls the H1 or H4 trend, the big 1-hour or 4-hour charts, and convinced itself the market would eventually turn back around. It overthought itself into a massive loss.
Exactly. A simpler bot cuts the loss immediately. GateGrid had so many complex filters that it essentially just froze.
But this massive failure is the exact reason the developer considered the day a triumph, isn't it?
100%. The diagnostic feedback is invaluable. The log shows the developer immediately interrogating the system. Like, was the session threshold too loose?
Or did the bot ignore spike in market volatility?
Right. Because a small, controlled loss isolates the exact variables you need to patch. Automated systems aren't judged by how they act in perfect conditions.
They're judged by how they fail in imperfect ones. Anyone can build a bot that makes money in a totally predictable market. The real engineering challenge is building the crumple zones.
You want an automated system that absorbs an unexpected impact and survives. not a glass cannon that shatters the moment volatility spikes.
Yeah, adding more AI doesn't make you bulletproof. It just gives you more things that can break.
And that small loss provided a really clear roadmap for improvement.
It really did. And, as you think about automating your own life, whether that's financial trading or just handing mundane tasks off to AI, it leaves you with a pretty critical question to ponder.
Yeah, what's the end game here?
Right. As we give AI more autonomy, should our ultimate goal be to build a flawless predictive filter that attempts to never lose? Or is it far more powerful to simply build a system that knows exactly when to admit it's wrong, hit the brakes, and cut its losses?